The investment committee debating whether this early year rally is now over and where the reversal could take us. Joining me for the hour right here at Post 9, Josh Brown, Stephanie Link, Joe Terranova, Shannon Sakosha. Everybody is here. Let's check the markets. We are down by about 550 on the Dow. Take a look at the S&P 500. We are, tell you what, you blink and we may be below 4,000, Josh, before you know it on the S&P. Certainly, if we're not careful, we may give that up. Seems just a matter of when, perhaps, at this point.
Yeah, so basically, I think we might have gotten ahead of ourselves. Oftentimes at the beginning of the year, especially after a bad year, everyone looks up and says, all right, last year was bad. It's very unlikely to follow a bad year with another bad year. And you see money being put to work by the likes of financial intermediaries who are rebalancing. They're taking money from what worked, adding to what didn't work. So a lot of that stuff is systematic. And then a narrative starts to form. You get a little bit of disinflationary data. People start to feel a little bit better than they had ordinarily felt. And then you get a situation where all of a sudden, VIX is at 17. And the market just completely looks out of character from what the prior trend is. What we're doing now is reversing that. You got a VIX back at 23. That is the highest we've seen since before Christmas. You've got a 30-day moving average for the puts call ratio at the lowest level since late 2019. That's going to now correct. You'll see a little bit more fear manifest itself in the options market. And I would just tell viewers who think that this is something new, it's not new. Typically, we see something like 3 separate 5% pullbacks in the market, regardless of whether it's from the high or not, in any calendar year historically. And that's an average. So oftentimes it's even more than that. So I think a pullback is okay. You understand it. It's coinciding with higher rates on bonds. A lot of the enthusiasm for a quickening pace of the Fed winding down now going away, and you're just seeing that push-pull here in the market. It's okay.
Steph, I think Josh nailed it, by the way, and I think it goes to why we got here in the first place. It was, positioning, and then he mentions a narrative. This narrative starts to build. Well, you can make a case, and some have, that it's a false narrative, built on the idea of a Fed pivot. Yeah. And the economy, okay, it's going to hang in there. We're going to have no landing, right? And then it feeds on itself. And I wonder if we're in the early stages of giving some of that back.
We could be giving it some of it back. I mean, we're up on the S&P 500 about 5% year to date, 11% on the NASDAQ. Technology is up 11%. Comm services up 13% after getting destroyed last year. And let's just keep this into context. The long-term total return average for the S&P 500 is 7%. So you're getting basically a whole year's worth of performance in a month, right? So I wouldn't be surprised to see a trading range. But I think I feel a little bit better, actually, about the overall economy, right? We talk about jobs all the time, initial claims, wages. Well, we got the ISM services number at a little bit over 50, and the composite also over 50. That's expansionary. Now, I'm not saying we're going to expand in a massive way, but services is the bright spot for this economy. Jobs is the bright spot. Initial claims is the leading indicator, and that is the bright spot. And so I think the consumer is in better shape. Retail sales we got last week was also better than expected, and I know we're going to talk about Walmart and Home Depot in the next block, but I think that there definitely are some bright spots in those companies and their reports. So I overall think earnings are going to hang in. I think 0 to 2% for the full year is too conservative, especially companies that have pricing power, and especially because you have the supply chains that are easing and you have China reopening. Not everything is hunky-dory. I get it. Housing stinks, and manufacturing is really on the cusp of a deceleration. But I do think overall, stepping back, I just feel better than where I had been.
Part of the problem, Joe, is that strength in the economy now is a problem down the road because it's only going to embolden the Fed. The Fed is only going to do more. They keep telling us that. It falls on deaf ears at some point. The bond market has started listening in the last few weeks. The stock market has, to some people, been delusional about what really lies ahead. And I see Shannon shaking her head. Yeah, too. But Joe, is that part of the problem? By the way, Jonathan Krinsky says we've broken some short-term uptrend for the S&P. UBS, conditions are not in place for a sustained rally. And then Mike Wilson really doubles down and sort of underscores this idea of what got us here in the first place. This false premise of a pivot. You roll in positioning. You've gotten multiple expansion that really can't be justified under current conditions. How do you want to respond to all of that?
I think today is a day where you have to talk about the taxable fixed income market. You have to look at what bonds are doing.